If you're spending a lot of time picking and tracking stocks for years and still struggle to get a sustainable compounded return, stop watching stock analysis videos and reading daily newsletters. In this episode, I will explain how exactly stock picking is slowing down your wealth building and what you should do instead to put your investment back on track and efficiently accelerate your financial success. Hi, I'm Prudence Zhu, CPA and financial planner. I came to the US in 2012 with few personal belongings. After 7 years of working and investing, I achieved financial freedom where I no longer had to work for money. And now I'm here to inspire and empower you to do the same. So to understand your investment returns, you must first differentiate investing and speculating, since many people mistakenly take speculation for investing. Investopedia defines investing as putting money to work for a period of time in some project or undertaking to generate positive returns. And speculation is conducting a financial transaction with a substantial risk of losing value by expecting a significant gain. In simple English, investment means buy and grow, whereas speculation means buy and resell. So the fundamental difference here is whether your money helps increase productivity and thus generate a return over time. So buying the stocks of a growing company is investing. And if you purchase something which you think the price is going to increase, at that point you'd be able to resell and make some profit. That would be speculation. Here's a pop quiz. If you think that the gold price will go up, so you buy gold, is that investing or speculating? Please take a moment to consider whether purchasing the gold results in the gold becoming heavier or producing smaller gold nuggets. And you'll soon realize that neither of the two is true. There's no increase in productivity. For that reason, it would be speculation. But if you buy the stock of a gold mining company, because you know they are upgrading equipment and acquiring more mines to meet the increasing market demand for gold, that is investing. By the way, in the past 30 years, the S&P 500, which is the red line, has grown to more than 8 times its original value. Dow Jones, which is the blue line, increased to more than 9 times, whereas gold, which is the golden line, only quadrupled in price. And silver in gray only 4.5 times higher. In addition, that only reflects the change in transaction price, and it does not include the value of dividends paid to the stock owners regularly. And if you add the dividends to the comparison, the total return would be even higher, as demonstrated in Wilshire Large Cap, or the black line, which grew to 15.6 times its value 30 years ago. And the only times gold outperformed the total stock return was for very brief periods between 2009 and 2011. So be aware of the increasingly popular advertisements about buying gold. You need to identify if you are speculating or investing, and if you are okay with the lower returns of gold over the long run. To recap, investing is buying for the prospect of increased productivity and thus increasing value over a period of time. On the other hand, speculation is buying in hopes of rising prices. What do Forrest Gump and Warren Buffett have in common?
He got me invested in some kind of fruit company. And so then I got a call from him saying, we don't have to worry about money no more. And I said, that's good. One less thing.
First, they are both passive investors. Second, they both made extraordinary returns by investing in great companies. For your information, passive investing is an investment strategy to maximize returns by minimizing buying and selling, according to Investopedia. That means you make significantly fewer decisions and perform minimal investment-related activities most of the time. On the other extreme, active investing refers to an investment strategy that requires the investor's constant buying and selling. And in other words, actively managing the portfolio or all investments. Interestingly, Morningstar, a reputable investment research firm, analyzed the fund returns between 2010 and 2020, and concluded that low-cost index funds outperform actively managed funds in most U.S. investment categories. That includes U.S. large-cap, mid-cap, and small-cap blend funds, and U.S. real estate. They also happen to have higher returns than other international investment categories. Active funds are usually managed by professionals with many years of education and investment experience. Moreover, older research also showed that most fund managers couldn't beat the market over the long run, and retail investors get an even lower return. And that's the first reason why stock picking doesn't work. It generates below market returns for most investors. And the second big disadvantage of stock picking is tax inefficiency. People who do stock picking tend to trade more frequently. If you buy and sell within a year, any price increase would be considered a short-term capital gain and taxed at your ordinary income tax rate. For most families making between $100,000 and $200,000 this year, their marginal tax is likely 22%. So if the market return is 10%, their after-tax return on short-term investment would be 7.8%, excluding state taxes. And if they held the investment for more than a year, the gain would be taxed at 15% long-term capital gain rate for the same families. Whereas if they invest the money through 401k or other pre-tax retirement accounts, all taxes would be deferred. That means they don't have to pay income tax on the contribution portion nor capital gain tax on the increased part as long as they leave it in the account. However, they will have to pay ordinary income tax when taking the distribution when they retire. Still, there are ways to optimize their tax liabilities down the road, so their marginal tax rate wouldn't be as high as 22%. And the best of all is if they invest it through an after-tax Roth account or health savings account. The funds would grow and can be withdrawn at retirement completely tax-free. The difference between 7.8% and 10% may seem insignificant in absolute value. However, when it comes to investments that grow year over year, it would create substantial differences in the long run. And I will illustrate the compounded return in more detail at the end of this video. The third disadvantage of stock picking is the high opportunity cost. Before coming to me, many of my clients spent a lot of time studying the stock market and tracking the performance of the stocks in their portfolios. Unfortunately, they only discovered their overall investment results were below the market return years later. They are primarily successful professionals and business owners. For them, it would make a lot more financial sense to spend the time deepening their expertise or focusing on growing their business. And both would significantly increase their earning potential. Not to mention, market volatility creates unnecessary stress for most people, even to financial professionals. Some may argue that stock picking provides entertainment value. In those cases, you have to consider if the joy of actively managing your investments outweighs the suboptimal gain. To summarize, considering the lower return, tax inefficiency, opportunity cost, and emotional stress, you would see clearly why stock picking may not be the best investment strategy for most people. However, if it brings you joy to manage your investments and financial return is not your primary concern, nothing needs to be changed. But most people invest for returns, not for the pleasure of the action of investing. Finally, let's talk about the incredible power of compounded return. And some call it the eighth wonder of the world. I made a couple of charts illustrating how lower returns can significantly impact wealth accumulation over time. Risk-averse Ricky has $6,000 today and hides it under the mattress or in a safe in the bank. It will never grow, so there is a 0% return. Saver Sophie puts the money in an outstanding savings account, generating a 2% interest. And it would slowly grow over time, but the purchasing power would weaken if inflation is more than 2%. Bond Brian puts it in treasury bonds, making 3.5% a year, and the money would double in 20 years and quadruple in 40 years. Mixer Megan puts it in a 60-40 equity and bond mix, meaning 60% of the money is invested in the stock market and 40% in bonds and rebalanced regularly. With an 8% average annual return, the money would double in 10 years. and be over $250,000 in 50 years. So if your kid is 15 and you put $6,000 in their custodial Roth IRA account, generating an 8% annual return, it would be $281,410 when they get to 65 years old, all tax-free. Lastly, Equity Ethan puts the entire amount in the stock market, generating a 10% annual return, and it would be $704,345 50 years later. And that's the power of compounded return. In the first 5 years, all 5 investors had similar dollar amounts. The difference starts to widen a few decades later, and that's why it's critical to have a good long-term strategy and be consistent and patient with it. Now let's look at an ongoing investment of $500 per month for all 5 investors. Again, you can see that in the first 10 years, the difference between an 8% return and 10% is relatively small. However, by the year 30, Equity Ethan with a 10% return would become a millionaire. With patience, Mixer Megan getting an 8% return would also become a millionaire a few years later. But by then, Equity Ethan would already be a multi-millionaire. On the other hand, the sad story is that risk-averse Ricky, saver Sophie, and Bond Brian with 0 or low single-digit returns will never become millionaires at the level they are investing, even though they also work and save diligently. I'm not saying that everybody should invest in the stock market. What you invest in should depend on your time horizon and risk tolerance. But the stock market, or a primarily stock portfolio, does provide the best chance for wealth accumulation over the long run. And starting as early as you can with the right strategy and consistency would give you a lot of advantages. An experienced financial planner can recommend a plan that fits your needs and even execute it for you. So they are definitely worth the money. I made a third chart to show you how much money you'll have to save and invest to have $1 million down the road. If your strategy is the same as risk-averse Ricky, it would take 50 years and you need to save $1,667 per month. Using only savings account as saver Sophie does, you would need 10 years less and $305 less each month. If you choose treasury bonds, it would take 30 years and require a monthly investment of $1,574. Using a 60-40 stock bond mix, you would need 20 years and a monthly investment of $1,698. With a 10% return, however, it would also take 20 years, but only $1,317 per month. And the best part is, the longer your time horizon, the less you'll have to invest each month. For example, if you started investing at the age of 15 with income from side hustles and getting a 10% return, you need to invest only $58 every month in your Roth IRA to have $1 million at the age of 65. And you'll have to bump up to $158 a month if you started 10 years later. If you started at 35, you'd need $442 per month for 30 years to get $1 million. And if you started at age 45, the monthly investment would have to be $1,317. And that's why you must begin consistently investing as early as possible. I hope today's episode inspired you to optimize your investment strategy and accelerate your financial journey. If you liked it, please give it a thumbs up and share it with others. We're also available on your favorite podcast platform under Invest with Prudence. Please subscribe to my channel to learn more tax and wealth strategies to build the life you want. See you next time!